Hey everyone, and welcome back to the channel. McDonald's just dropped its Q3 2025 earnings report, and it's a classic case of good news, bad news. The Golden Arches are seeing solid sales growth, but they stumbled slightly on profits. So what's really going on with this fast food giant? In this video, we're breaking down the key numbers, the CEO's insights, and what it all means for investors. Let's dive in. McDonald's Corporation, ticker MCD, is one of the world's largest and most recognizable fast food restaurant chains, operating over 40,000 locations in more than 100 countries. Founded in 1940 as a barbecue restaurant, it was reimagined in 1955 by Ray Kroc as a franchisor, establishing the speedy service system that became its hallmark. The company's business model is primarily based on franchising, with approximately 93% of its restaurants owned and operated by independent franchisees, which provides a stable revenue stream through rent, royalties, and initial fees. McDonald's is renowned for its core menu items, including the Big Mac, Quarter Pounder, and world-famous fries, and it continuously adapts its offerings to local tastes and global trends, such as with the McCafe line and digital ordering through its mobile app. As a component of the Dow Jones Industrial Average, McDonald's is a global leader in the quick-service restaurant industry, generating billions in annual revenue and maintaining a powerful brand through massive marketing, operational efficiency, and a relentless focus on convenience and value. First, let's look at the headline numbers that had analysts talking. On earnings, McDonald's posted an adjusted EPS of $3.22. This fell short of Wall Street's forecast, which was around $3.35. On revenue, the company brought in $7.08 billion. This was just a hair below the expected $7.10 billion, but it still represents a 3% increase compared to the same quarter last year. The real strength, however, was in comparable sales. Globally, they grew by a healthy 3.6%, driven by strong performance in international markets like Germany and Australia. Even in the competitive U.S. market, same-store sales rose by 2.4%. So, why the mixed picture? On the earnings call, CEO Chris Kempczinski provided crucial context. He highlighted a major trend we're seeing across the economy: the bifurcated consumer. Essentially, lower-income customers are tightening their belts and spending less frequently. However, traffic from higher-income customers remains strong. This is a pattern McDonald's expects to continue well into 2026. To navigate this, the company is doubling down on what it calls the 3 Ds: delivery, digital, and drive-thru. Their strategy is a balancing act, emphasizing everyday value and affordability to attract budget-conscious diners, while also using menu innovation and marketing to keep the broader customer base engaged. According to Kempczinski, this approach is working, helping them gain market share despite the economic pressures.
Beyond the sales figures, the underlying business metrics were strong. System-wide sales jumped 6%, and consolidated operating income was up 5%. The company is actively investing in its digital infrastructure and global marketing campaigns to fuel future growth. A key tactic right now is co-investing with franchises in value meal promotions to drive customer traffic. This support is expected to taper off by early 2026. Looking ahead, management is cautiously optimistic. They're forecasting accelerating sales growth in the fourth quarter thanks to blockbuster seasonal promotions like the Monopoly game and the reintroduction of popular value meals. McDonald's Q3 2025 shows a company with strategic resilience. While higher tax rates and restructuring charges put pressure on their bottom line, the core business is demonstrating remarkable adaptability. They're successfully navigating a tricky economic environment, posting solid sales gains and maintaining growth momentum. The possibilities. McDonald's is playing its classic strengths while innovating for the future. Value and menu innovation. In a tough economy, a focus on value is key. McDonald's is doubling down on affordable meals and new menu items, which is helping it gain market share from competitors and appeal to budget-conscious customers. Aggressive global expansion. The company isn't standing still. With plans to open around 2,200 new restaurants in 2025, primarily in high-growth markets like China, it's laying the groundwork for long-term revenue streams. Diversifying revenue. Did you know McDonald's is making a serious push into beverages? With an expanded lineup of cold brew coffees and fruit drinks, it's directly targeting cafes like Starbucks, creating a new reason for customers to visit. Digital and loyalty power. Digital sales and loyalty programs are a huge growth engine. These investments are paying off by driving repeat business and giving McDonald's valuable data on customer habits. Analyst optimism. Because of this strong strategy, many analysts remain bullish. Some have price targets projecting the stock could reach between $330 and $370 by the end of 2025 and beyond, signaling confidence in its resilience. That's a compelling growth story. But to get the full picture, we have to look at the significant challenges the company is navigating. Declining traffic. A critical issue has been a nearly 2-year trend of declining visits from lower-income consumers in the U.S. This highlights the real economic pressure on a key part of their customer base. Earnings pressure. Profits are being squeezed from multiple angles. Higher effective tax rates, restructuring charges, and the simple fact that ingredients and labor cost more are all putting pressure on the company's margins. Macroeconomic uncertainty. Elevated costs for housing, fuel, and other essentials mean consumers have less discretionary income. This is a broad challenge that could limit sales growth across the entire industry. Valuation concerns. Some analysts argue that the stock's current price already reflects much of its expected growth. This means there might be limited upside in the near term, leading to a wait-and-see approach from some investors. Fierce competition. The battle for the value-conscious customer is intense. From other burger chains to a growing number of fast casual options, McDonald's can't afford to misstep. You have a company with a proven playbook for growth, global expansion, and digital engagement that positions it well for the long term. This makes it a potentially steady, resilient holding. However, in the near term, it's highly exposed to the pressures on the lower-income consumer and broader economic uncertainty. This creates volatility and could limit short-term gains. When we talk about reliable dividends, we look for one thing above all: consistency. And McDonald's has it in spades. The company is a certified dividend aristocrat, and it's knocking on the door of becoming a dividend king. How's that for a track record? They have increased their quarterly dividend payment for 49 consecutive years. That's nearly 5 decades of rewarding shareholders through thick and thin. And the best part? The streak is still going strong. Just recently, in October 2025, McDonald's announced a 5% increase in its quarterly dividend, bringing it to $1.86 per share. This move signals strong confidence from management in the company's cash flow and future earnings. It's not just a token raise, it's a statement.
So, let's break down the numbers. What does this mean for you as an investor? With a new quarterly dividend of $1.86, the annual payout comes to about $7.44 per share. At its current stock price, that gives McDonald's a dividend yield of around 2.48%. Now, a yield around 2.5% is solid, but the real magic is in the growth and, crucially, the safety of that dividend. This is where the payout ratio comes in. McDonald's payout ratio is in a very healthy range of about 55 to 60%. What does that mean? It means the company is using a little over half of its earnings to pay dividends. This is the sweet spot. It's conservative enough to be sustainable during an economic downturn, but it also leaves plenty of room for future increases without straining the finances. And those increases have been steady. Over the past several years, McDonald's has grown its dividend at an average annual rate of 7 to 9%. That's a powerful combination of a decent starting yield and consistent, above-inflation growth. The overall consensus on McDonald's is best described as cautiously positive. If we look at the data from over 30 major analysts covering the stock, the picture is balanced. Roughly a third to half are in the buy or moderate buy camp. However, the single largest group, about half of the analysts, are recommending a hold.
Only a very small number suggests selling. This tells us that Wall Street sees stability in McDonald's, but is also waiting for clearer signs of strong, explosive growth. So, what about potential gains? The average analyst price target sits between $324 and $330. From its current level around $300, that suggests a modest but respectable upside potential of about 6 to 12%. It's not a moonshot, but for a stable company like McDonald's, it represents a solid expected return. But some firms are significantly more bullish. For instance, Citigroup and BMO Capital have set outperform ratings with price targets as high as $345 to $375. They point to McDonald's undeniable strengths, its value leadership in a tough economy, powerful global marketing, and its ongoing global expansion as key drivers for growth. Most see McDonald's as a hold or a moderate buy. They acknowledge it has incredibly solid long-term fundamentals. It's not going anywhere. However, based on its current valuation, the near-term upside appears limited. It's viewed as somewhat fairly valued to slightly undervalued. For investors, this means McDonald's remains a core holding for stability and dividend income, but if you're looking for dramatic short-term growth, you might be disappointed. That's our breakdown of McDonald's stock. Are you considering adding MCD to your portfolio, or are you holding steady? Let us know in the comments below. Don't forget to like and subscribe for more analyst insights. Thanks for watching.